Hello and welcome to CandiMentor. Today, we decode US GAAP ASC 842, the lease accounting standard that transformed how American companies report leasing arrangements. It aligns in spirit with global IFRS 16, but has key differences that matter in practice. Before we dive in, hit subscribe to CandiMentor. Why ASC 842 exists. The big picture. ASC 842 replaced ASC 840 to bring transparency to leasing activities. The goal is straightforward: reduce off-balance sheet financing. Most leases now appear on the balance sheet as a right-of-use asset and a lease liability. This applies to corporates, private companies, and nearly every sector except for arrangements governed by specific industry guidance. A concise summary: ASC 842 recognizes almost all leases on the balance sheet, improving comparability and reflecting economic reality. Summary. Scope. What counts as a lease? A contract contains a lease when it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Control means the customer directs how and for what purpose the asset is used and receives substantially all economic benefits. Common U.S. examples include warehouses, trucks and equipment, office space, data center capacity, dedicated servers, and embedded leases inside service contracts. If the supplier can substitute the asset and the substitution is substantive, then no lease exists. The two-layer model. Right-of-use asset plus lease liability. At lease commencement, the lessee recognizes two items: a right-of-use asset and a lease liability measured at the present value of lease payments. The right-of-use asset represents the controlled resource. The lease liability represents the commitment to pay over time. This dual recognition mirrors IFRS 16 in structure, but differences appear later in classification and presentation. Initial measurement, lease liability. Include in the lease liability fixed payments, variable payments tied to an index or rate, residual value guarantees, payments for purchase options when reasonably certain, and termination penalties when reasonably certain. Discount using the rate implicit in the lease if known. Otherwise, use the incremental borrowing rate. For private companies, ASC 842 allows an election to use the risk-free rate, a US GAAP-only feature to remember. Example: annual payments of $10,000 for 3 years at a 6% rate yield a present value slightly under $28,000. Initial measurement, right-of-use asset. The right-of-use asset equals the initial lease liability plus initial direct costs and prepaid lease payments, less lease incentives received. If a lessee received landlord incentives, for example, 3 months free rent, reduce the right-of-use asset by the incentive amount. Lease classification, operating versus finance. Under US GAAP, leases are classified as either operating or finance. Finance leases resemble legacy capital leases. Operating leases remain operating in the P&L pattern despite balance sheet recognition. 5 tests indicate a finance lease: transfer of ownership, purchase option reasonably certain to be exercised, lease term covering a major part of asset life, present value of payments equating to substantially all fair value. Asset is specialized with no alternative use. If none apply, the lease is operating. Classification affects expense presentation and timing, and is a core conceptual difference from IFRS 16. Subsequent measurement, finance lease. For finance leases, recognize interest expense on the lease liability and amortization on the right-of-use asset. The expense pattern is front-loaded. Typical entries each period: debit interest expense, credit lease liability. Debit amortization expense, credit accumulated amortization, right-of-use asset. End. Subsequent measurement. Operating lease. Operating leases produce a single straight-line lease expense in the income statement. Underneath the hood, interest and amortization still exist, but they are combined into one straight-line cost for presentation. The practical outcome: total lease cost is recognized evenly over the lease term, even though the liability's interest portion declines and the ROU asset amortizes. Reassessment and remeasurement. Reassess and remeasure when lease terms change, when purchase option likelihood changes, when indexed payments change, or when modifications occur. Remeasure the liability using a revised discount rate where required, and adjust the right-of-use asset accordingly. Lease modifications. New lease or adjustment. A modification changes scope or consideration. If the modification adds a separate right-of-use asset priced at standalone terms, treat it as a separate lease. Otherwise, adjust the existing lease. For example, adding extra floor space at negotiated standalone rates is often a separate lease. Minor scope or price changes generally lead to remeasurement. Variable lease payments. Variable payments not tied to an index or rate are expensed as incurred. Payments indexed to CPI or similar are included in the lease liability only when the index changes. Initially use the index at commencement for measurement. Indexed adjustments are common in U.S. commercial real estate and warehouse leases. Short-term lease exemption. Leases with terms of 12 months or less and no purchase option may be expensed directly without balance sheet recognition. This exemption is elective and must be applied consistently. Low-value assets, not available under US GAAP. Unlike IFRS 16, US GAAP does not provide a low-value asset exemption. Except for short-term leases, most leases are recognized on the balance sheet under ASC 842. This distinction is frequently tested. Impairment of the right-of-use asset. Test the right-of-use asset for impairment under ASC 360 when indicators exist: reduced use, business restructuring, or impairment of the related cash-generating unit. Recognize an impairment loss if recoverable amount falls below carrying amount, and adjust subsequent amortization. Thank you for listening. Subleases. Classification matters. Classify subleases based on the right-of-use asset rather than the original underlying asset. A sublease covering most of the ROU asset's life can be a finance sublease even when the head lease is operating. Common examples include part leasing of data center or warehouse space. Sale-and-leaseback. Control is key. Sale-and-leaseback accounting under ASC 842 is a two-step assessment. First, determine whether a sale occurred under revenue guidance. If a sale is recognized, only the gain attributable to rights transferred is recorded. If no sale, treat the arrangement as a financing transaction. The analysis hinges on transfer of control under the revenue model. Presentation, financial statement placement. Present operating and finance lease liabilities either separately or in disclosures. Operating lease expense appears as a single line. Finance lease expense is split into interest and amortization. Cash flow classification. Operating lease payments typically present in operating activities. Finance lease principal is financing, while finance lease interest is often operating, subject to policy decisions. Understand how presentation affects ratios and analysis. End. Disclosures. Extensive under US GAAP ASC 842 requires detailed disclosures, including maturity analysis, weighted average discount rate, weighted average remaining lease term, total operating and finance lease expense, variable lease payments, short-term lease expense, and qualitative judgments about renewal and discount rate assumptions. Filings in the U.S. are often prescriptive and granular. Detailed U.S. industry examples: retail, storefront leases, tenant improvement allowances, percentage rent. Logistics and transportation, fleet leases with per mile or usage-based pricing. Real estate, build-to-suit arrangements and sale and leaseback transactions. Technology and cloud services, data center capacity and embedded leases in outsourcing contracts. Manufacturing, equipment leases and related party lease arrangements. Industry examples help connect principle to practice. Odds. Numerical example, simple illustration. 3-year lease with annual payments of $10,000 and a 6% discount rate. Present value is approximately $28,000. Record the right-of-use asset and lease liability at this amount. If classified as operating, recognize a straight-line expense of $10,000 per year. If finance, recognize interest on the liability. Liability times 6% in year 1, plus amortization of the ROU asset. Journal entries, full debit, credit narration. Initial recognition. Full debit, right-of-use asset. Credit, lease liability. Operating lease expense each period. Full debit, lease expense. Credit, lease liability. Credit, right-of-use asset amortization adjustment. Finance lease, interest and amortization. Full debit, interest expense. Credit, lease liability. Full debit, amortization expense. Credit, accumulated amortization. Right-of-use asset, payment of lease installment. Full debit, lease liability. Credit, cash. Practical guidance and key reminders. Focus on classification logic. Finance versus operating. Understand that the balance sheet reflects both types of leases. Remember that under the hood, operating leases split into interest and amortization, even when presented as a single expense. Be familiar with remeasurement and modification mechanics, the short-term exemption, and the absence of a low-value exemption in US GAAP. Know where ASC 842 differs from IFRS 16 and how those differences affect presentation and ratios. Final wrap. ASC 842 is designed for clarity, consistent recognition, and transparent disclosure. Recognize the right-of-use asset and lease liability. Classify correctly, apply the appropriate expense pattern, and disclose the key judgments and maturity profiles. Mastering ASC 842 means understanding structure, mechanics, and the practical impacts on financial statements and business analysis. If you learned something today, subscribe to CandiMentor. We're building the world's best learning hub for accounting, finance, and professional practice, and you should be part of it.